Welcome to Money Matters TV. I'm your host, Mike Dever. I'm founder and chief innovation officer of Brandywine Asset Management. And my co-hosts today are Jeff Watkinson of Watkinson Capital Advisors and Eric Parnell of Great Valley Advisors. Hello, Eric and Jeff.
Hello, Mike.
Good afternoon, Mike.
Well, I think we can jump right into things today because we've got, here we are, beginning of June 2026, and it doesn't seem like it's a sell in May and go away. First of all, because we're in the middle of the largest tech rally. I was just reading this morning, largest 10-week gain in technology stocks in history, which is almost hard to believe because we had 1990s, 1999, but this has been just so relentless and pretty much it's almost like every day it's another percent. Just moving up and, rallying like crazy. And that's now heading us into an IPO summer, something that is, I think we could say, truly unprecedented, where we have potentially three IPOs, each in their own right, record-breaking 2-to-1, bigger than any other previous IPO ever issued. And that would be SpaceX coming next Friday, potentially June 12th, Anthropic, and then OpenAI. So I'd love to get your views on that overall, the feeling of the market. Is it all warranted? Is it frothy? Are these IPOs good investments for people? What do you think here? Eric, you want to give us a start on that?
Yeah, it's the market has been phenomenal since the end of March. It's hard to believe that we were here 2.5 months ago, just in the markets in general. And there was a lot of concern about the potential implications of the Iran conflict. Well, that's been long forgotten. We have stocks that not only broke out above 7,000, which was the previous all-time high mark set in January, but we're fast tracking our way to 8,000 on the S&P 500 as we sit here in early June. I mean, that's a phenomenal move in a short period of time. And, this AI trade it's been going for about 3 years now, and it is starting to look pretty frothy. Now, fundamentally, you can make the case, say corporate earnings growth over the next year is projected to continue to run at double digits. And a lot of that is coming from the tech sector. But there is something that's fundamentally changed associated with this AI trade over the last year, because there was a time when companies were just making big profits, generating huge cash flows, and looking forward to the unbridled optimism of how AI was going to change the world. Well, now in 2026, in the summer 2026, we're operating with AI companies that they're burning through free cash flow. They're spending massive amounts of dollars on CapEx. And maybe they're not going to hit these revenue and earnings targets that have been so aggressively put out there for so long. And if they do fall short after all this CapEx, what does this mean for the lofty valuations that are underlying these stocks?
And you're also seeing companies like Google, which is just a cash machine, actually go into the market to borrow $80 billion to be able to continue to build out its data centers and essentially support its AI initiatives and ambitions. So we're moving from a position where companies were just printing cash to where now they've actually got to go to the markets, Oracle, bring cash in from other means. Jeff, you have a view on this, and from your angle, what are you seeing?
Yeah, we have those magnificent seven. Yeah, you have Google, one of the most profitable companies ever, maybe the top 5, and they've exhausted their CapEx. They're going an equity offering, and the market didn't really like that this week. I guess the corporate debt market, and yeah, it's a extraordinary time in the equity markets, and I'm really interested in hearing what Eric has to say on the IPOs coming up.
Yeah.
How to prudently play those, how to get exposure in a thoughtful, how to get exposure and how to do it in a thoughtful way, quite frankly.
Yeah. So Eric, what do you think there? I mean, we're seeing, so next week with SpaceX, the numbers they're talking about are $1.75 trillion valuation, maybe 6 months ago, valuation would have been half that, which is actually where Morningstar came out yesterday to say they see the valuation. You've got $75 billion that's going to be raised in the IPO. 30% of that from retail investors, direct to retail investors, which is a great market for Musk since he's got such a following there. And then they just amended the S1, I believe, to talk about additional substantial raises. So they're not going to this is not just an IPO. This is a continuing fundraising effort that SpaceX is going to be making. And we saw the financials. SpaceX before XAI and X was profitable. I think maybe $8 billion, decent margins, all because of Starlink mostly. Some of that's from the launch business. But now you roll in XAI, and all of a sudden you're piling on 13 billion last year, maybe 30 billion this year in losses. It's just going to be, compounding. Is there a way out of that? Are they going to turn the corner? Are they going to become profitable? Should people go into the IPO as a speculative play? Should they go in there as a long-term hold? And how can they do it if they do want to do it, Eric? What do you think?
Yeah, no, I think the first thing it's important if we remove all the names and we just take a look at IPOs in general. There's a lot of risks associated with allocating to an IPO that don't exist with stocks that have been trading on an exchange for an extended period of time. So I think the first message I would say to any investor out there, regardless of the IPO, is be careful, because there's a lot of buzz around companies when they become public, but there's the historical price performance associated with IPOs is very mixed at best. There's some IPOs that have performed tremendously well after the initial public offering. There's others that have performed not well at all and have dropped in price. And really, the outcome tends to be somewhat random in many cases. And because there's a lot of mechanical things that are happening, for example, like lockup periods where the company goes public, but there's certain shareholders of the company or the owners of the company that aren't able to sell their stock for the first 6 months. So you tend to see a lot of unpredictable price behavior associated with IPOs, no matter how good the story is, at least for the first 6 months to 1 year after an IPO takes place. So be careful out there if you're thinking about allocating to an IPO. Now, let's take a look at the companies that we're talking about here specifically that are set to IPO here in the coming weeks. You have SpaceX. This is a company, as Mike, you did a great job of mentioning that SpaceX itself is profitable, but you're also getting elements of other things that are thrown in with the SpaceX IPO, one of those being XAI. At the IPO price, you're talking about a company that's trading at 95 times sales. Not 95 times earnings, but 95 times sales.
Because there are no earnings, so we can't base it on earnings.
Exactly. And so it is very speculative. Now, they're doing a lot of cool things, but it's important to keep in mind that the valuation at IPO is historically stretched and historically rich for a company of any kind. So that's something that's really important to keep in mind. It's an expensive company.
And normally I would say, okay, that's definitely a red flag, and it wouldn't shock me at all for a company like that to come out like Facebook did, roaring out of the gates and then drop in half before it hits stride and the company starts growing into its valuations. But there's something different happening this time, and that's the fast track into the indexes. And what do you think that's going to do for the stock price? Because what means for the people who haven't been following this is generally when a company becomes public, there's usually a waiting period as long as a year before that company is able to show 4 quarters of profitability and a variety of things to get included in the NASDAQ 100 or the S&P 500. Musk campaigned and got accepted by these benchmarks to fast track companies into those benchmarks if they meet certain criteria, primarily if they're one of the top 10 companies by market cap. Mm-hmm. Now, what that means, since these indexes are market cap benchmark, now there's some constraint on that with free float, but is that these benchmarks, these indexes, NASDAQ 100, for example, 15 days after the IPO is essentially going to be required to buy SpaceX stock. And when you kind of do the math on it, it looks like about half that float that's going to be issued at the IPO is going to be consumed by passive indexes and active indexes that essentially are benchmarked to those passive indexes. So normally I would say big pop, things rally, everybody's excited, and then you have this slow sell-off. But I'm almost feeling like you could have the equivalent of a short squeeze here when these indexes have to acquire this stock. I mean, what do you think? I haven't modeled it, but just off the top of my head, it just seems like it could be a scary squeeze.
You're absolutely right, because we're kind of in uncharted territory with this type of thing. And maybe it's the traditionalist in me, but I always take pause when I hear that rules are being changed or exceptions are being made, because there's no precedent to reflect on to say, well, what are the implications of those changes? And they can lead to the exercise of the law of unintended consequences. And that's one of the things that we're going to need to see play out, because not only are we talking about a very large company IPOing into the marketplace and getting exceptions in order to being added into an index, what does that do to all the other stocks that are around that stock, where the oxygen is being taken away from them in order to fund this big new position that's being dropped into the index? So it's going to be interesting to see the knock-on effects here.
Yeah. Do you think this is a net negative for technology stocks because of that air getting sucked out of the room? I mean, that 75 billion that's going into there has to come from somewhere. And if they continue to do add-on secondaries, 30 billion here, 40 billion there, whatever it is, that money's got to come from somewhere. And is it people selling NVIDIA, Micron? I mean, how are they freeing up the cash to be able to buy the SpaceX?
It's one of the things, it's the continuation of the need in the AI trade to increasingly separate the winners from the losers. And I think that's going to be part of that manifestation, is that one of the things that's not being talked about with this IPO wave is that the investment capital to purchase these stocks and allocate them to the index, it has to come from somewhere. And at a time when CapEx spending across the board is going off the charts, at a time when maybe there's not going to be sufficient demand to support all the CapEx spending that's being executed on, this, I think, is just a continuation of separating winners and losers. And it'll be interesting to see who's left on the losing side when it's all said and done.
Right. Okay. Now, Jeff, do you see the fact that we've got now all these companies going to market, raising debt, doing new equity offerings, the IPOs that are going to be pulling money out of the market, we've seen a somewhat of a rise a little bit in like treasuries and some yields, primarily from the knock-on effects of higher energy prices from the Iran war. Is that something that's affecting your markets, what you're seeing?
It's a great question, and it really depends on what day you ask me. I mean,
is that right?
That couple of weeks ago, the 10-year Treasury and the 30-year Treasury was very soft, and our current bond prices went down. Those prices bounced right back to a week later, 10 days later. The municipal bond market, there's a very good chance we'll have another year of record new supply, new issuance. And the demand for munis has been very strong all year, measured by net capital going into municipal bond mutual funds. So,
okay. So there's liquidity and there's cash out there. I mean, it might be we just soak up these IPOs and it's not an issue, right? Now, what do you think, Eric, from the standpoint of first out the gate? Obviously, SpaceX is going to be first out the gate. Anthropic looks like they might be second out of the gate right now. OpenAI third. Is there any kind of precedent for establishing, it's better to be first, it's better to let the market get established, come in second? How are these all going to play out over the next couple months?
Yeah, I think it's going to be really interesting because SpaceX, since they're going first, they're going to set the tone and they're going to set the spirit for it. Because if it is a situation where SpaceX stumbles out of the gate, I would argue that that may be a healthy thing because it will help rein in some of the investor exuberance around these companies coming to the public marketplace. On the flip side, if it is a situation where SpaceX, no pun intended, rockets to the upside after the IPO, it is really going to feed the appetite and the interest in investors to say, wow, we saw how this first one played out. Well, let's figure out how we can get on board with the second one and the third one. One of the things with that in mind is that it's interesting. I think SpaceX is probably the most widely held, publicly, held IPO that's coming into the marketplace. There are a number of ETFs and mutual funds that are in the marketplace right now that hold private positions in SpaceX ahead of these IPOs. So if you're looking for a way to get that allocation, that would be one way to do it in a reasonable way. But be careful out there with that type of stuff as well.
Yeah, I mean, this is right, very unusual. A company like SpaceX that's got over 2 decades of actual corporate history, products building. They've essentially been a privately public company for a decade now. There are a lot of mutual funds in it. There's plenty of individual investors certainly that own stock in SpaceX today. So it's not your typical IPO that's coming out after 5-6 years of some seasoning and has some insiders with some stock, and that's the extent of it. So what do you make of SpaceX? Let's just say, because they've got this deal where they're leasing part of Colossus, their data centers out to Anthropic. They're getting $1 billion plus a month for that, with just regular growth and Starlink and their launch business. So let's say they're going to be at a run rate of 40 billion or something like that, like right now. So how does that and running at a loss? Whereas Anthropic's coming in now saying that their run rate is over 40 billion and they're profitable. How do you sort of justify one SpaceX being worth maybe 2x the value of the other one when the other one's got same run rate, faster growth, and profitability?
Yeah, it's it highlights the forces of liquidity and some of the enthusiasm that can really take hold in financial markets when the liquidity is out there. I mean, you think about the company that's been publicly traded for so long in Tesla. For years, one could take a dubious eye at the financials of Tesla, yet the company was just relentless to the upside because of the innovations that they were bringing. And what really drove that enthusiasm was the boundless liquidity that existed in the financial marketplace in the post-financial crisis period. So, that investor enthusiasm and that theme-driven investing, I think we should expect it to continue regardless of fundamentals until we hit a point where liquidity starts to become constrained. And that could come sooner than later, because we have some brewing inflation pressures that are continuing to bubble underneath the surface. We have a Federal Reserve that everybody was wondering, were they going to cut interest rates too aggressively at the beginning of the year once we had a change at the head of the Federal Reserve? Well, now we're looking at a situation where the Fed may be raising interest rates as soon as the fall or the winter. And that means liquidity coming out of the marketplace. And if enough liquidity comes out, then the sentiment around those types of theme-driven narratives can change real fast.
Yeah, we saw that. I was talking about that earlier this week here in the office when KKR was buying out Philip Morris back in the 1980s, and it put essentially a top in the market there for a period because it just was too much. It was asking too much for the market at the time. Liquidity just didn't appear that was necessary for that to happen. And now we're asking about, some hundreds of billions of dollars over the next few months in liquidity to be poured into these 3 IPOs that we have. Forget whatever secondary kind of offerings that happen. Forget about all the other raises like Google's 80 billion for data centers. The commitments are 800 billion, close to $1 trillion this year in data center build outs, and it's been funded. People are continuing to fund it, but there will be a point where somebody says, you know what, I don't think we need this capacity. I don't see it being supported by the end user. And essentially that's what happened with Elon Musk with Colossus. I mean, he built those data centers in unbelievable record time. And then was sitting there with all this extra capacity and gigawatt capacity for compute without XAI growing into it. So fortunately, he's now got that to be able to sell that to companies like Anthropic that do need that compute. So it worked out well for him to be in the data center business more so than the AI business, essentially. But at some point, I think you have people sitting around the table going, this next 80 billion, I don't think I'm into that. And that's when it crashes fast, I think, at that point. I'm not saying it's the end of that market. This is like the internet. It'll have a period where it's massively overbuilt. All the fiber's been laid, for example, with the internet. And then you find out you've got 10 times the capacity you need to meet demand. And that's gonna happen. I don't know in what way it's gonna happen, whether people figure out more efficient ways to do the compute that they need to do. The training's not as bad. I mean, it doesn't take as much. Something's going to change though, where we find that we've overbuilt. That's almost inevitable in this environment.
Mike, I hear you. I think it's time for our question from the audience.
Go ahead.
Okay. This week's question is from Edward T. Smith of Philadelphia, Pennsylvania. What role should taxes play in your planning for good investment decisions? So I'm going to defer this one to Eric.
Yeah, I think Eric's our guy for this.
Yeah. So taxes should not be something that drives your investment decision. You want to allocate your investments in order to optimize your rate of return. But taxes is something that should be a consideration. Now, one of the things that I always like to say is that 85% of something is a lot better than 100% of nothing, and that's why you don't want to let it drive your investment decisions. But it is something that you want to take into consideration. And kind of building off the topics that we've talked about so far, the AI trade has generated significant unrealized capital gains for a lot of investors over the last few years. And there's a lot of areas of the market to be really enthusiastic about over the next few years that you may want to reallocate into. One of those areas that help address those tax questions and help you manage your taxes even better in accounts that are not IRAs or non-qualified taxable accounts are municipal bonds. And municipal bonds provide a great way for investors to manage those taxes within the asset allocation process. So if you do have an account that you have to pay taxes on every year, you really want to think about the role that municipal bonds can play in that type of portfolio, particularly given the valuations that we see in municipal bonds in the current market environment. So, and that's, I turn it back over to our municipal expert, Jeff, to talk a little bit more about that on that front.
Thanks, Eric. You really put it on a tee there for me. It's really difficult. That's a conversation we've been having for years with investors with the large gains. Don't you think it's time to take a little money off the table, lock in those gains? You have $1 million gain. Why don't we take $300,000 and invest it in the municipal bonds where you know exactly when you're going to get your money back, your principal back, when and how much each coupon payment, your interest will be. It's kind of like eating your vegetables. Plus, you will be paying capital gains taxes, but it's a prudent move. It's kind of like eating your vegetables that are left on your plate. You need to do it, and it may not be super pleasant, but and it's hard. The stock market keeps running away.
I was just going to ask that for both of you, Jeff and Eric. Is it difficult to get people to step aside and take some of that off the table? Because what we're seeing is, and as you know, Eric, we're doing a 351 exchange into some new ETFs, which lets people move in tax deferred, diversify their portfolio, add downside protection. But there's a chunk of people who their clients, we're talking advisors, the clients just saying, well, it's going up every day. Why would I get out of it now? They just can't make that move when literally it's been averaging almost 1% a day for 2 months in price action for their technology stocks they're in. So how do you handle that? How do you get that investor to realize that, that's great, but at some point, again, the whole pigs get slaughtered story.
Yeah. It's a difficult discipline to master in investment markets. And it's one of those things in any other marketplace, people like to buy things that are cheap and then sell things that are expensive. But when it comes to stocks, investors like to hold on to things that are expensive and they like to sell things that are cheap. It's a difficult discipline for people to master. And I think, Mike, what you mentioned is really the best way to go about it, is the recognition that we have been in a seemingly endless upward trajectory in stock prices. Yes, we had the COVID crisis in 2020 when the 2022 bear market, but really it's been more than a decade of stocks just being relentless to the upside and to buy every dip imaginable. But there is nothing wrong, just as we learn if you go into a gaming place or a casino, there is nothing wrong with taking some chips off the table. Be able to allocate to continue to participate to the upside. And yes, you might have to realize a tax associated with it, and talk about tax management. You can sell things at a loss to offset those gains in your portfolio, and that's one of the things that's helpful. Tax managed processes and portfolio management. But there's nothing wrong with taking some gains off the table and taking 85% or 80% of a lot and reallocating it to the cheap things that are in the market that are all over the place right now. Technology has sucked up so much oxygen in the marketplace that you have 8 other sectors of the S&P 500 where stocks are trading at their deepest discounts in nearly 40 years. You have areas of the bond market that are tremendously attractive right now that investors aren't paying attention to, understandably, but keep that in the back of your mind. Find a way to continue to participate, but to reallocate to those other opportunities in the market. Take some chips off the table.
Yeah, right. Okay.
I like finding ETFs that automatically rebalance for me, takes the decision out of my hands, whether it's an equal weight, but does it automatically in a tax efficient manner, takes that decision out of my hands.
Nice. Yeah. And in our marketplace with 401k plans, it's really what you see is the default investment everybody's going into is the target date funds, because it takes that decision out of people's hands. It doesn't do it on a market timing kind of basis. It does it just based on, hey, you're getting closer to retirement. Let's reduce some risk in the portfolio. And that's the vast majority now. Money in 401k plans is going into those because it's a single decision. You make the investment and then you walk away. It works out. It might not be optimal, but it's better than what had been happening with people trying to time in and out and panicking when the markets were selling off. Well, I appreciate your time again, guys. This was great. We have an interesting summer ahead of us. It'll be fun to see what happens with all these IPOs we have coming out. So thank you very much. Our next guest on Money Matters TV is Dr. Sean Patel. He's CEO of Prep Expert, and he will discuss scholarship fraud. Until then, thank you for watching Money Matters TV, where your money matters. See you next time.